Welcome to this explainer. Today, we're taking an absolutely incredible journey. We're going from wooden ships carrying spices across dangerous, unpredictable oceans, all the way to the highly complex global economies that literally run our world today. We're going to unpack exactly how a working stock market functions as the true engine of our modern economy. Okay, let's dive into this.
To keep us on track, we've got a clear roadmap today. We'll start with the world's first stock market, move on to launching an IPO, look at supply, demand, and value, figure out how to navigate market noise, and finally, talk about the everyday investor. Section 1. The world's first stock market.
To really understand how a working stock market functions today, we actually have to travel all the way back to the 1600s. Picture this. The Dutch East India Company needs funding for these incredibly expensive global voyages. They were sending hundreds of ships out to trade gold, porcelain, spices, and silk all over the globe. But as you can imagine, the financial burden was just way too massive for one single entity to carry alone. So a completely new system emerged. A few months later, they turned to everyday private citizens. The deal was, individuals could invest their own money to support a trip, and in exchange, they'd get a share of the ship's eventual profits. Fast forward a few years, and these shares were actively being bought and sold in coffee houses and shipping ports across the continent. Basically, by seeking private funds for these grand voyages, they unknowingly invented the world's very first stock market. Pretty crazy, right?
So what does this actually mean for us? Well, at its core, a stock, or a share, is simply an investment made by an individual to support a business in exchange for a portion of its profits. It is a brilliantly simple concept. Companies collect funds from willing investors so they can expand. But beyond just raising money, this mechanism provides something absolutely crucial for a working stock market to function efficiently today, and that's liquidity. It allows investors to buy and sell their ownership stakes seamlessly, so capital is literally always flowing to where it's needed most. What started as guys trading pieces of paper in coffee houses has grown into this massive global system with entire schools, careers, and television networks dedicated solely to understanding it.
Section 2. Launching an IPO. Let's move to and see how this builds, because obviously the modern stock market is a bit more complicated than its 1600s incarnation. How do companies actually use the market to raise capital today? Well, imagine a brand new coffee company that decides it wants to grow and scale up globally. How does that private idea become a publicly tradable company? First, they pitch themselves to big institutional investors. If those big players think the company has strong fundamentals, they get first crack at it. Then, they sponsor the company's initial public offering, or IPO. This effectively launches the coffee company onto the official public market, where anyone, individual or institution, who thinks the business will be profitable can jump in and buy a stock.
Now, this is a super important point. Buying stocks makes those investors partial owners in the business. It's not just some abstract transaction, It literally means those investors are taking an ownership stake and their funds directly help the company grow. It's capital allocation at its finest. Investors provide the fuel, the capital, and the business uses that fuel to innovate, expand, and, fingers crossed, increase its overall value.
Section 3. Supply, demand, and value. Let's zoom out a bit. When we look at the macro relationship between investor interest and company value, we see the true engine of a working stock market, supply and demand. On one hand, you have an upward trajectory. If demand for a stock increases, the price rises, right? This grows the value of the shares people already own, and the company's overall value grows along with it. But we have to contrast this with the downward trajectory. If a company suddenly seems less profitable, the exact reverse happens. Investors get nervous, they sell their shares to protect their money, and as those stocks flood the market, demand drops. The stock price falls, pulling the company's value right down with it.
And this leads to a truly fascinating psychological loop. In the stock market, merely appearing to lose value often leads to losing actual value. Wait, how does that work? Well, a working market is heavily influenced by fear and greed. Just the perception of a dropping stock price can trigger a total panic. People start selling off their shares out of fear, which means real-world valuations can plummet purely based on changing investors' sentiment. It leaves investors with huge losses, completely disconnected from the actual fundamentals of the business. That is, until the company can prove it's still profitable.
Section 4. Navigating market noise. Now, what's really interesting about this next part is how it highlights all the external, totally uncontrollable variables impacting our hypothetical coffee company.
Because let's face it, it's not just about how good the coffee is. Any company is at the mercy of external market forces. We're talking about the fluctuating price of materials, sudden changes in production technology, or shifting costs of labor. Investors are constantly sweating over changes in leadership, bad publicity, new laws, trade policies, or even just other investors selling off shares for their own personal interests. All these variables combine to create this massive wall of daily market noise. This noise can make a company look like the next big thing, or completely doomed, regardless of what they're actually selling.
Which brings us to a rather profound quote. Human confidence in the market has the power to trigger everything from economic booms to financial crises. I really want to emphasize the gravity of that. This difficult-to-track human element anchors the stock market as an emotional ecosystem. It's not just a mathematical one run by cold, hard spreadsheets and algorithms. Ultimately, it's driven by people.
Section 5. The Everyday Investor.
So, how do you actually navigate an emotional system like that? Well, because of all that unpredictable day-to-day noise we just talked about, most professionals strongly promote reliable, long-term investing over trying to make a quick buck. That human variable makes short-term, rapid trading incredibly risky. By focusing on steady, long-term growth, everyday investors can effectively anchor themselves against the wild volatility of a working market, relying on the historical upward trend of the economy instead of panicking over today's news cycle.
So the crucial point is how the internet has completely democratized trading. Today, everyday investors can buy stocks just like the massive institutional investors do. The old barriers to entry, they're gone. Everyday people can educate themselves on this complex system, support the businesses they genuinely believe in, and actively pursue their own financial goals. The internet has literally given you the exact same tools to participate in global markets.
But of course, the first step is actually getting invested, which leaves us with this final question. How will you educate yourself and pursue your own financial goals? I really want to challenge you to take everything we've just covered about how a working market functions and apply it to your own financial literacy journey. The tools are right there waiting for you. Thanks so much for learning with me and this explainer today.